Welcome back to my podcast, The 5 Minute Echo. This week's episode is a little different. Instead of my usual reflections on everyday life, I want to share something I've been thinking about while reviewing my portfolio. How global investing can add a layer of growth and diversification to your investments. Last week, I was reviewing my portfolio after the recent correction that happened in the stock market, especially after the AI related carnage in IT stocks. And while doing that, I realized something surprising. Most of the companies driving breakthrough innovation, AI, biotech, EVs, cloud tech, aren't even in India. And yet, nearly all Indian investors are fully invested in Indian equities only. But unlike most of you, I decided to increase my SIP in one category of mutual funds that is not really advertised a lot in India and where retail participation is still very minimal. When I say unlike most of you, here's why. Every month, Indians invest roughly 30,000 crore rupees through SIPs into mutual funds. Out of that, barely 900 crore rupees goes into international mutual funds, which means for every 1000 rupees invested in Indian equity funds, only about 28 or 29 rupees goes into international funds. That's less than 3%. So when markets correct, most investors double down on domestic funds. Very few look outward. And this is not necessarily wrong. India has delivered strong returns. Over the last 10 years, the Nifty 50 has delivered roughly 12 to 13% annually. This is solid, consistent compounding. We believe in India's growth story. I do too. But here's the uncomfortable truth. India represents roughly 3 to 4% of the global equity market capitalization. Yet, most Indian portfolios are nearly 100% India based. This is not asset allocation, this is home bias. Let us add global context here. Over the last year, India's Nifty 50 gained about 10%. The US Nasdaq rose 20%. South Korea's Kospi jumped 110%. And over the last 3 and 5 years, Kospi has grown roughly 30% and 12% annually. Brazil's Ibovespa is up 45% and China's CSI 300 is up 18% over the last 12 months, showing how global markets can often outpace India and why diversification matters. Another perspective to consider. Investing in India does not automatically mean exposure to global innovation. India is largely service driven. Most frontier technologies, AI, semiconductors, biotech, advanced robotics, is all led by companies listed overseas. A small international allocation gives exposure not just to geography but to global innovation cycles, companies that are actually creating new technologies and industries. This is not about abandoning India, it is simply adding another layer of growth that India alone cannot provide. Different regions play different roles in the global growth story. The US and Europe drive tech and pharma breakthroughs. Different regions play different roles in the global growth story. The US and Europe drive tech and pharma breakthroughs. India focuses on services and manufacturing, Brazil on mining, and China on EVs and AI innovation. Diversifying across geographies means capturing all these growth engines. Let us take some real examples. Nvidia, the AI hardware giant from United States. Over the last 5 years, its stock has delivered roughly 65% plus annualized returns, turning $10,000 into over $100,000. Or consider Eli Lilly, the pharmaceutical innovator behind drugs like Monjaro. It has returned roughly 39 to 40% annually over the same period. These are the companies creating breakthrough technology and products, not just providing services. The wealth generated comes to those who actually own a piece of these innovators. That's why even a small global allocation in your portfolio can give exposure to growth India alone cannot provide. Here's another perspective on global investing. Out of the top 20 biggest companies in the world by market capitalization, about 16 are from the US, one from Taiwan, one from China and Hong Kong, and not a single one is from India. These are the companies driving breakthrough innovation, technology, and global growth. India has strong domestic champions, but none of them make it into this global top 20 list. That's a reminder. Even a small international allocation gives exposure to the very companies shaping the future. A quick note before we continue. International funds are a great diversification tool, but they are not risk free. Currency fluctuations, global market volatility, regulatory changes, higher expense ratios, and different taxation rules can all impact your returns. So, even while considering a small global allocation, it is important to be aware of these risks and balance your portfolio accordingly. Now, naturally, if these are the returns and diversification is discussed so widely, why are international funds still underowned? There are a few reasons. 1. Home bias. Familiarity feels safer. 2. Distribution incentives. Domestic funds are easier to explain and sell. 3. Slightly higher expense ratios in international fund of funds. 4. Regulatory overseas limits. 5. Recency bias. India has done well, so investors assume it always will. None of these reasons make global investing wrong. They just explain the inertia. Let us talk cost. A Nifty 50 index fund may charge you around 0.15 to 0.2% as expense ratio. A Nasdaq 100 fund of fund might charge you around zero point 0.6 to zero point 0.7. Yes, this is higher, but historically, the rupee has depreciated roughly 3 to 5% annually against the dollar over long periods. That currency movement alone can outweigh this cost difference in the expense ratio. So, the real debate is not about expense ratio, it is concentration risk versus diversification. And just to clarify, this is not an investment advice. These are historical numbers. Markets move, returns change, everyone's allocation depends on their own risk profile. This is simply a conversation about diversification. When we diversify into real estate, gold, or silver, we are reducing concentration risk. International mutual funds can be viewed the same way, not as a replacement for India, but as an additional layer of geographic diversification with liquidity. Unlike property, you can exit tomorrow. Unlike gold jewelry, there are no making charges. And unlike a single country bet, you are exposed to global innovation, earning cycles, and currency diversification. So, what am I saying here? Not 50%, not abandoning India, not chasing US tech. If you are investing rupees 10,000 per month in Indian equity funds, maybe 1,000 rupees can go global, a simple 10% or even less. Not because India is weak, but because no country leads forever. Diversification is not about predicting the winner. It's about making sure you are never fully dependent on only one. And sometimes the least crowded trade is simply balance. This is the 5 Minute Echo. If this episode gave you a new perspective on investing, follow my channel. Share it with someone building wealth the smart way, because the right idea at the right time can change a portfolio forever. My podcast is available on Spotify, Amazon Music, Apple Podcasts, and YouTube. Thank you for listening. I'll see you in the next episode. This is the 5 Minute Echo.